I'm Jake Carpenter, Vice President of Investor Relations here at Equilus Capital Partners. And I want to welcome you today. We're going to talk a little bit about 1031 exchanges, as well as a few different capital gains deferral strategies that maybe you haven't heard of. So a little bit about me. I grew up in Central Washington. I started my career in financial services in November of 2006. I've worked in estate planning, business succession, wealth transfer, asset management, and real estate through real estate investment trusts. And today we're going to provide you with some information through our pre-recorded session. I want to give you a quick minute to grab a pencil and a paper and write your questions down, because at the end of this pre-recorded session, we're going to have a live question and answer session. And believe me, some of this information is going to be really new to you and very, very exciting. So you're going to want to write your questions down and make sure that we get an opportunity to address all those questions that you have for us. So a little bit about Equilus Capital Partners. Equilus Capital Partners works jointly with Equilus Financial Group. They source real estate investment projects throughout the Northwest. And Equilus Group, Inc. provides asset management as well as trust and advisory services, as well as an installment sales trust to manage capital gains liabilities that are addressed through the installment sales trust. So in essence, I work in concert with Equilus Capital Partners and Equilus Group, Inc. To provide the capital gains deferral strategies from start to finish. Our mission is to protect and grow our investor wealth through income-producing real estate opportunities. So a little bit about, I want to share our disclosures here. I'm not going to try to give any tax and legal advice today. So in giving you this information, I want to encourage you, if you're thinking about moving forward in any kind of real estate investment or investment at all, you're going to need to consult with your own CPA and attorneys. And of course, carefully consider the investment objectives, the risk factors, charges and expenses before investing. And again, we're not going to try to give any legal or tax advice, but we're going to share some exciting, probably new information with you that you're going to probably have a lot of questions that you're going to need to write down so we can address them at the end in a live question and answer session. So let's talk about tax deferral strategies. And I know maybe many of you out there, I've already heard of a 1031 exchange, but as a company, we specialize in tax deferral strategies that are both legal and ethical. As a macro advising firm, we work with some of the best firms in the professional arena, both in law, accounting, finance, and real estate, to serve the best interests of our clients. We utilize proven processes and strategies to understand the unique situations that surround the clients and the businesses that we work with to serve them the best. We value education, and we try to keep up on the most current, cutting edge, up-to-date information that's coming out of both the real estate and investment markets to make sure that we can provide that information directly to you through the strategies that we implement. Okay, again, most of you probably heard of 1031 exchanges. Maybe many of you know a lot about 1031 exchanges, but I'm going to give a little bit of an overview of some of the benefits and maybe some of the pitfalls of utilizing or considering a 1031 exchange. First of all, in a 1031 exchange, the value of your current property is exchanged for a like-kind property of equal or greater value. Okay, so if you're selling a current property, investment real estate or farm, you can invest those proceeds in something that is considered like kind of equal or greater value. Secondly, the like kind property must be identified in 45 days of the sale. This can make a 1031 exchange very, very difficult and maybe prohibitive under some conditions. The closing must occur within 180 days. So this provides a very strict, stringent window of 45 to 180 days to identify and close on the property. Again, that can be problematic for some of you real estate investors that are maybe wanting to take your time in considering and looking at a new real estate opportunity. It's a great strategy for someone wanting to grow their real estate portfolio. Someone that might use a 1031 is in most cases could be younger, looking to grow their real estate portfolio, or maybe they're older, and they're just looking to keep going and continue growing their real estate portfolio. This is a great option if you already have a like kind property identified. Maybe you've had that property, kind of in your peripheral, and you're paying attention to, what's going on with that potential real estate investment property, and a good buyer comes along for your current real estate that you're holding, and the individual that owns the property is ready to sell at about the same time you're looking to sell your property. They're wanting to sell theirs. So a 1031 exchange under the right circumstances can be very good. It's an option to achieve capital gains deferral. So primarily people look to utilize 1031 exchanges to take that capital gains tax bill, defer it, and push it down the road a ways so that they don't have to address that tax bill now, but they can address it later. Okay, let's move on. The first capital gains deferral strategy that I'm going to talk about that maybe you have heard about and maybe you haven't heard about is called the 721 exchange. A 721 exchange, where does that name come from? It comes from, in essence, the IRC code 721. It's also known as an umbrella partnership real estate investment trust, the acronym being UPREIT. It only applies to properties that are held in LLCs or corporations. So I'm going to talk about that in a little bit more detail of how you might position them in LLCs or corporations. So again, 721 exchange could be an alternative to a 1031 exchange. You just need to make sure you're working with a professional so that whatever strategy you use is, in essence, serves the purpose that you need it to serve, both in your financial and personal realm. Lastly, the 721 exchange, the property is traded for shares in a real estate investment trust or a REIT. So 721 exchange allows the property owner to transfer their real estate position from an active to a passive role. So let's talk about that. Again, when we were talking about a 1031 exchange, generally folks that a 1031 exchange seems to be most appropriate for, they're people that want to stay active in managing, owning, and running their current real estate positions. So for someone that may be getting older, or someone that may have a lot of property and they don't want to actively manage all of their property, but maybe start to maintain or achieve a more passive position in real estate, a 721 exchange might be appropriate for that. There is no capital gains tax in the trade because the value is embedded in the shares. So let's talk about that. First of all, the property has to be an LLC or a corporation, and they allow the sales proceeds to transfer from their current real estate position into a passive real estate position in something called operating units. Then the capital gains tax is deferred, and this trade is allowed to achieve those capital gains status because the value is embedded in the shares. The shares are liquid and can allow the owner to sell a few shares at a time and control, in essence, their capital gains tax bill. Okay, so that's a lot of information to take in all at once. But again, let's go through that in a little bit more detail. The first step, so I'm going to take you through the first step of how a 721 exchange process takes place. First of all, let's just say I'm an owner, multifamily property. He's looking to sell, he's got a capital gains problem. Let's make sure that property is inside of an LLC or a corporation. So if it's not currently inside an LLC, we need to reposition that inside of an LLC or a corporation. Some examples of this type of property could be rental property, office buildings, farms, ranches, or even businesses. Step 2, valuation of the property. When we work with people, there's two ways that people primarily value their property. First of all is they've got a buyer that's willing to pay X amount of dollars, and the seller is happy with that, so now we've got ourselves a value. Secondly, if the seller's not quite sure what the property is worth and there isn't a buyer on the table, one of the things that we may want to consider is a certified appraisal. So once we've identified that property, we've got that property in an LLC or a corporation, now we've got a value. And we've either obtained that value through getting an offer that's acceptable to the seller, or we've gone through a certified appraisal in achieving the value on that property. Step 3, the real estate investment trust management company becomes the managing partner of the property prior to the sale. This establishes the umbrella partnership. Really, really, really important detail that I need to add right now is that no matter what strategy you use, you must start working with a professional ahead of time to make sure your strategy is set up and ready to go. Because if you get too far in the sale and the strategy is not set up appropriately and you have to back up, it may cause that deferral strategy to fail. So step 3 in the 721 exchange process is the real estate investment trust management company becomes the managing partner of that LLC or corporation. The property prior to the sale, so this has to take place prior to the sale, and this establishes that umbrella partnership. Okay, what happens next? Step 4, the share value of the property is traded into the umbrella partnership or the UPREIT for equal shares of something called operating units inside of the real estate investment trust. For example, that multifamily property is worth $750,000. The buyer is willing to pay it. I'm willing to sell for that amount. I've got my property inside the LLC. A real estate investment trust has come in and partnered up with me as the managing member of that. The real estate investment trust goes ahead and sells that property and credits me $750,000 worth of operating units inside of their real estate investment trust project. Okay, as long as I hold those operating units in the form of an operating unit, I achieve capital gains deferral. So an operating unit pretty much functions the same as a share unit. It provides me with a dividend. It provides me with capital appreciation. All the benefits I get with a share unit, I get with an operating unit. Okay, so some of the benefits of a 721 exchange after we've gone through that process. Step 4, we've achieved by repositioning those operating units inside of a real estate investment trust project. Now I start enjoying income from a passive position in real estate. I no longer have to take advantage, or I no longer have to deal with the trash and the toilets and the liabilities that come with managing my own property. So once those operating units are positioned in that real estate investment trust project, my income starts. Secondly, the benefit of depreciation starts. One thing to pay attention to that I'm just going to throw in there that's a little bit of a kind of a benefit when it comes to investing in real estate investment trusts is our projects specifically, they don't hold projects longer than 12 years. So you're allowed to go into a 12-year accelerated depreciation schedule. Now, for those of you who have residential or commercial properties that are on 27.5 or 39-year depreciation schedules, you know what the potential benefits, the absolutely huge benefits are that come with a 12-year accelerated depreciation schedule. This is something that you can gain access to through the real estate investment trust position through in exercising a 721 exchange. Then lastly, you receive quarterly dividends. The income from the rents paid on those projects flows through to you through the operating units on a quarterly basis. So again, if you have questions, please write them down because I'm more than happy. We're going to go over all your questions at the end in a live question and answer session. Some more advantages to the 721 exchange. Really importantly is you can manage your tax liability instead of the IRS. Some of you folks out there have and are facing a potentially huge tax liability with these capital gains tax. By repositioning through the use of a 721 exchange, Once you take that 750,000 that came from the story that I just told, you can take that 750,000 and reposition and decide how much or how little of that you want to pay in capital gains tax. Maybe you have something come up that requires a quick need for cash. An investor that's exercised a 721 exchange can sell some of that repositioning of operating units, in essence, converting an operating unit to a share unit and then selling those to recoup some cash that may be needed in an instance that you might need some liquidity or liquid cash. Now, if you do this, you need to make sure that you understand that you're going to create a capital gains, potentially could be creating a capital gains tax liability, but you can control how much or how little of that tax liability that you want to address at that time. Secondly, is you have control of if and when you sell your shares and how many shares you sell. So that's kind of what I was talking about in if you want to sell one operating unit, two operating units, because you need cash or you just need to create some liquidity for yourself, you can decide how many and how few that you want to sell. It's just you may have to face the capital gains liability on that amount of those units that you sell. You participate in capital appreciation and capital depreciation inside the real estate investment trust. This is huge because most of our real estate investment trust properties are on a 12-year accelerated depreciation schedule, and they're pretty nice properties that are positioned in a very opportune position where you can really take advantage of some of the upswing of that capital appreciation. In essence, folks that utilize our 721 exchanges are able to sell high and buy low in properties that have a lot of potential appreciation in them, instead of exercising a 1031, which may be selling high but also buying high. All right, so that's a 721 exchange. Now I want to move to another strategy called an installment sales trust. This again may be another strategy that you've never heard of. An installment sales trust comes from IRS Code Section 453, which is an installment sale to a third party. So it's nothing new. This property is put into a trust and managed by a trust company for the benefit of the trustor. You don't pay taxes on the asset inside the trust. Only when the trustor takes a distribution from the trust is the portion taxable per capital gains tax schedule. So who is the trustor? The trustor is the seller. Okay, so let's go through this in a little bit of a step-by-step. So backing up into a 1031 exchange, I want to kind of compare this to a 1031 exchange. Unlike a 1031 exchange, an installment sales trust does not require the taxpayer to reinvest back into like-kind properties. That is absolutely huge. In fact, a seller of a property can even exit real estate altogether through utilizing an installment sales trust, being that the proceeds, some or in its entirety, can be repositioned in stocks, bonds, mutual funds, precious metals, really any position that you'd like them to be in. Unlike a 1031 exchange, an installment sales trust has no pressure to purchase another property. So there is no 45 to 180 day window that you have to be making sure that you're operating within in order to achieve your deferral. You can wait for the right opportunity. How great would that be to sell out of a property that's highly appreciated and you have time to do the vetting and the checking and run your comparables to a property that's going to do what it needs to do for you and not have to have a time schedule that you need to stick to in exercising that transaction. Partnership interest can be served. Each individual can have their own installment sales trust that is managed to serve the individual's preferences. What I'm talking about here is the business that's owned by three partners. Two of them want to stay in the business, one of them wants to leave. So each individual can have their own installment sales trust, or one of them can have just one installment sales trust. They can sell their 1/3 of the business. The other two partners can stay. that third that sells out of the business can still achieve capital gains deferral on the sale of his highly appreciated piece of that business. So that's really important to know if you're a business owner and you're partnered up with someone else. For those of you that aren't business owners but know business owners, you need to tell them about this. This is really, really huge when it comes to exiting a partnership that may not be going very well for you. So I want to give you a visual of how the installment sales trust works, more specifically in a little bit of a flow chart here. So first of all, we start on the left here with a highly appreciated piece of real estate. This green box around the property represents an installment sales trust, or it's a trust that we form. We title that property into the trust. Then we put it up for sale. Once the property sells, in essence, this trust is the entity that's selling the property. You're left with cash inside of the trust that can be invested. Doesn't have to be invested in like-kind property. It can be invested however you want, in whatever way serves your best interests and your needs. So the money from the sale is generally diversified into investments, including real estate investment trusts, based on what is appropriate for the client. So some of it, someone may reposition into real estate investment trust projects. Some of it may go back into ordinary real estate that they would manage. Some of it can go into stocks and bonds. But this is a really important flow chart to understand all the flexibility that comes with an installment sales trust. Okay, advantages of an installment sales trust include tax deferral. Of course, we want to defer those capital gains tax, put that bill back in our pocket to generate more income and growth. There's an estate tax benefit because once someone passes away, that trust can be distributed however you want. So, for example, if the cash is invested in stocks, bonds, mutual funds, or real estate investment trusts, those can be distributed through beneficiary designation. So you can give 1/5 to all 5 of your kids, or you can give 50% to one of your children, 50% to another, or you can give it to church, charity, in whatever way you'd like. Again, it maintains family wealth because we take a very illiquid asset. Maybe it's multifamily properties, a farm, or a business, and we convert that to cash inside the trust. So we maintain family liquidity and wealth. And then there's estate liquidity because it can also be kept in a very liquid position inside the trust, and it avoids probate because it's inside of a trust. So I want to thank you again for joining me on this informational presentation. Again, I don't want to come across as saying 1031 exchanges are bad, because they're not. They're great for the right person. But I wanted to share with you a couple of other capital gains deferral strategies that may be something that you can use in your toolbox when it comes to addressing, investment and real estate capital gains issues within your own planning situation. I want to thank you again for joining us. This is our contact information if you want to reach out to us, and if you've got further questions that you want to talk to someone, I'd be happy to visit with you. Again, we're going to have a live question and answer session immediately following this. I hope you're all taking care of yourself, and I want to thank you again for participating, and I look forward to visiting with you soon directly after this in the question and answer session. Thank you so much.